Despite a cooler than expected June jobs report on Friday, rate hike worries persist. Unemployment slipped back to 3.6%, and wages grew 4.4% from 1 year ago. My next guest says the economic data is improving, and the recession obsession can wait until next year. Joining me now is Invesco global market strategist Brian Levitt. Brian, thanks so much for coming by.
Absolutely. Great to be here.
So let's start with inflation on everyone's mind, of course. You say it's slowing, but clearly the market says it's not slowing enough for Jay Powell's liking.
Yeah, it's not to Jay Powell's liking, but we're getting there. So when we're going to get the consumer price index report, everyone's been waiting. When's it going to get to the low threes? When's it going to get to the high twos? Actually, if we climb this month, what we've been climbing on average this year, you're going to be in the low threes on a year-over-year percent change. So that's good news. Core remains too high, but a lot of that is shelter. And if you look at other indicators such as the Case-Shiller Home Price Index, or you look at what's going on in the rental market, they're coming down. CPI shelter usually lags by 10 months, 12 months, so you're going to see that come down as well. We're getting close. The bond market is telling you that, at least in the break-evens. So we're getting closer to the end of this tightening cycle.
That's the good news. The bad news is that you say, while we're going to escape recession in the near term, it's a business cycle, so you do see a recession eventually.
Yeah, all business cycles end. Right now, they don't all have to be as catastrophic as the last two recessions, 2020 and 08. And so we have this recency bias that they're all disastrous and policymakers need to come in with substantial support. We've had recessions like in 1991 where that was not the case. And actually, this is playing out similarly to 1981. Inflation peaked in March of 80. Fed raised rates through the end of the year. You had a telegraphed recession, but the market had already priced a lot of it, and you started to see the early stages of a new market cycle. What ultimately became a nice bull market. So, yeah, we still need to see the lagged effects of all this policy tightening. It's a lot in a very short period of time. The economy will continue to slow. But for investors, I think we've priced it already.
Well, speaking of that, what is the investor playbook? If it's priced in, does that mean there's nothing to buy because it's all fully priced? What do you think?
You know, over the next year or two, investors should do quite well in risk assets. Typically, if you look the year or two after inflation has peaked, the markets do quite well. We're already 1 year after inflation peaked. The markets are up 17%, right? That's pretty close to average in the year after inflation peaked. In the 2 years after, they tend to do quite well. In the year after policy tightening ends, markets tend to do quite well. So I think investors are going to do well. The challenge is, which part of the markets do you want to be in? And we're sort of bouncing between the markets thinking soft landing versus the markets thinking too much tightening.
Sure.
And, you know, when you're in that, you want to be a little bit more defensive. It's the mega cap, growthier names. When the market starts thinking soft landing, it's more of the small value and non-US dollar names. So you may bounce between a recovery trade and a wait. We've got to contract a little bit here a few times over the next months. But if you're thinking out over the next year or two, it's going to be a new market cycle. And you want to be in smaller cap, you want to be in risk credit, you want to be more value oriented, and you want to be more exposed to the non-US dollar.
It's painful to buy all of those things. International stocks, small caps, value have all done pretty badly over the past decade. But you just have to realize when they've done badly for a long time is the time to buy?
Well, they're more reasonably priced, but what you're essentially saying is you need a catalyst for them to do well. And we never really had that catalyst in the last cycle because anytime they started to get going, the Fed would raise rates. Right, or we'd start a trade war and something would slow down global growth. So that catalyst is usually improving global growth, and that's what would typically happen as you're coming into the next cycle. You get that improvement. Now, that doesn't mean value and small are going to outperform for the next decade. It means that in the early stages of a new market cycle, in the year or two after inflation has peaked, you tend to do well in those parts of the market. It doesn't mean we plow out of our growth stocks. Look, you're thinking about a balanced portfolio. Where do you tilt? In a recovery, small, non-US dollar, those types of things.
Okay. We got to go in about 20 seconds, but a good reminder for investors. You said don't jump out of the market every time you get scared.
Don't jump out of the market every time you get scared. We've seen far too many times recently, whether it was COVID, whether it was concerned about Fed rate hikes, Russia, Ukraine, people got out of the markets. It is almost always, or I'm not going to say almost always, it's always a fool's errand to try and time these things.
Brian, thank you so much for coming.